Now we shall see comparative income statement. This comparative income statement is a horizontal analysis wherein we are going to compare a particular item over the years. We shall pass on to the problem number 1. Prepare comparative income statement from the following. Revenue from operations, sales, that is the total revenue from sales. This is on 31st March 2012, we have 4,20,000. 31st March 2013, we have 8 lakhs. Purchases of stock in trade, that is the goods purchased, 2,50,000 in 2012 and 4,50,000 in 2013. Changes in the inventories of stock in trade, 50,000 as on 2012 and 50,000 as on 2013. Other expenses, it is 10% of cost of goods sold and 8% of cost of goods sold respectively. Taxation, it is 40% in 2012 and 50% in 2013. Now, this other expenses 10% on cost of goods sold should be calculated on purchases plus changes in the inventories of stock in trade. That is 2,50,000 plus 50,000 will get 3 lakh rupees into 10%, that will be the other expenses for this year 2012. Then for 2013, 4,50,000 plus 50,000, 5 lakhs into 8%, that will be for 2013. Now, this is the problem regarding the income statement. Now, we are going to prepare a comparative income statement. I shall tell you how to calculate these amounts and we shall pass on to the solution later. See, in this year 2012, we have 4,20,000. In 2013, we have 8 lakhs. See to the increase or decrease over the year. Compare it to the previous year. Here it is 4,20,000, this is 8 lakhs. So, compare it, we will get the difference of 3,80,000. So, this will be the difference between these 2 years. So, this is the increase over the sales from 2012. Now, the percentage to be calculated as increase or decrease divided by the previous year into 100. That will be the percentage of increase or decrease. Same way we have to calculate for purchases of stock in trade, then changes in the inventories, other expenses and the taxation. We shall pass on to the solution. Comparative income statement for the years ended 31st March 2012 and 13. See to it, first 2 columns are the amounts that are given in the problem. As such, we have written it. Revenue from operations, we have 4,20,000, this is 8 lakhs. We have expenses, that is purchases, 2,50,000, 4,50,000. Changes in the inventories, 50,000, 50,000. Other expenses, as I have already told, we have to add purchases and changes in the stock, inventories into the other expenses percentage. The same way for 2013, we have calculated. This will be the total of your expenses, namely purchases, changes in the inventories and your other expenses. So, it comes to 3,30,000 for 2012 and 5,40,000 for 2013. Then this is the profit which is calculated right from your revenue, total expenses are deducted and will have a revenue of 90,000 for 2012 and 2,60,000 for 2013. Now, the taxation should be calculated as given on the problem as 40% and 50%. It comes to 36,000, that is 40% of 90,000 and 50% of 2,60,000. So, this is the tax that is calculated on your profit before tax. After deducting tax, we will get the profit after tax as 54,000, that is 90,000 minus 36,000, I will get 54,000. Here 2,60,000 minus 1,30,000 will get 1,30,000. So, this is the way in which it is to be represented for your comparative income statement. Let us now see the third column, namely absolute change, that is the increase or decrease over the previous year. See to it, 8 lakhs is your sales in 2013, 4,20,000 is your sales of 2012. So, we have an absolute increase of 3,80,000. As we have a positive figure, we do not put as plus, we will simply write the number. Suppose if we have a decrease, that is a negative figure, we will put it in brackets. So, any figure represented in the brackets implies that it is a decrease. Same way the purchases of stock in trade, we have 4,50,000, 2,50,000. So, we have an increase of 2 lakhs. Changes in the inventories of stock in trade, that is we have 50-50, we don't have any change, so nil. So we can put an hyphen stating that it is nil. Other expenses 30 to 40, we have a 10,000 as increase. So total expenses we have 3,30,000, 5,40,000. So this is 2,10,000, that is the net increase. Then profit before tax 90,000 and 2,60,000, we have 1,70,000 as net increase. Then taxation, we have paid 94,000 excess in 2013. The same way profit after tax will get 76,000 as an increase. Now let us see to the last column and let me explain how this percentage is calculated. See to it 90.47, I will tell you how this 90.47 is arrived. Now what is the absolute change in this sales? 3,80,000. So we will get 3,80,000, that is the absolute change, divided by, this is your absolute change, divided by the previous year figure, that is 4,20,000. 4,20,000 is your previous year figure into 100. This is your 90.47. That is, we have to take it as increase or decrease divided by the previous year. Divided by the previous year into 100. This is the way in which we have to calculate the percentage of change over the base year. Base year we mean normally the previous year. Whenever we take 2 years, we have to take the previous year as a base year. So 3,80,000 divided by 4,20,000 into 100, it will give you 90.47. This implies that we have 90% increase of sales over the previous year. That is the implication we have. That is the interpretation we can make it from here. Purchases of stock in trade, we have 2 lakh rupees. This 2 lakhs divided by 2,50,000 into 100 will give 80%. That means we have 80% increase in the purchases. Once again, whatever percentages we get it in positive figure, we have to write it like this. Suppose if it is a negative figure, we have to put it in brackets. I am reminding of the same. Changes in the inventories, we don't have any changes, so nil change. Other expenses, we have 10,000 increase. So 10,000 divided by 30,000 will get 33%. Now coming to the total expenses, we have 5,40,000 and 3,30,000. We have 2,10,000 as increase. This 2,10,000 divided by 3,30,000. So every item should be horizontally compared. So go to your previous period and compare it. So 2,10,000 divided by 3,30,000, I will get 63.64. Profit before tax, we have 1,70,000 divided by 90,000, that will be 54%. Then we have less tax, that is your taxes 94,000 divided by 36,000 into 100 will get 261%. Profit after tax will have 76,000 divided by 54,000 will get 140.74. So this is the percentage of increase over the last year. So whenever we take the percentages, it may be more than 100 because it will go up to 500% or 600%, etc. So this is the way in which we have to calculate your percentages. That is increase or decrease divided by your previous year's figures into 100. We shall pass on to the next problem. From the following statement of profit and loss, prepare a comparative income statement of X Limited. We have income, revenue from operations 30 lakhs in 2012, 33 lakhs in 2013. Other income 60,000 and 60,000. We don't find any difference here. Total of your income 30 lakhs and 60,000, 33 lakhs and 60,000. Expenses include purchases of stock in trade, changes in the inventories, employees benefit expenses, finance cost and other expenses. So see to it, purchases we have 23 lakhs in 2012, 24 lakhs in 2013. Changes in the inventories 1 lakh rupees in 2012, then 1 lakh 20 in 2013. Employees benefit expenses 70,000 in 2012, 90,000 in 2013. Then finance cost 60,000 in 2012, 60,000 in 2013. Other expenses 80,000 in 2012 and 90,000 in 2013. We have the total of expenses as 26 lakhs and 10,000 in 2012 and 27 lakhs and 60,000 in 2013. Now profit as total of your income minus your total of expenses, which comes to 4,50,000 in the previous year and 6 lakhs in the present year. Now tax payable is 50%. Now let us see how these items are recorded in a comparative income statement. As usual, we said we have the revenue from operations, other income, we have the total revenue, expenses, we have purchases, changes in these inventories, employees benefit expenses, finance cost, other expenses, we have the total expenses, profit before taxes, total of your income minus your expenses, we will have the profit before tax, then less income tax at 50%, we will get the profit after tax. Now we have to calculate the absolute change, or that is increase or decrease over the previous period, again percentage of change, or that is percentage change, either it is increase or decrease. Let us see each and every item one by one. Revenue from operations, it is 30 lakhs and 33 lakhs. We have 3 lakh of your absolute change. Now 3 lakhs divided by 30 lakhs, we have 10%. Now 60,000 and 60,000, we don't have any change, so there is no percentage of any changes here. Then total revenue comes to 30 lakhs and 60,000, here 33 lakhs and 60,000, so the difference is 3 lakhs. Now 3 lakhs divided by 30 lakhs and 60,000 will give you 9.80. Purchases, we have 1 lakh as difference, 1 lakh divided by 23 lakhs will get 4.35%. Then again changes in the inventories, 20,000 divided by 1 lakh will get 20%. Employees benefit expenses, 20,000 divided by 70,000 will get 28.57. Finance costs, we don't have any change, so it is nil change in your previous, over your previous year. Then other expenses, we have 10,000 as change, 10,000 divided by 80,000 will get 12.50. Then total expenses, we have 1,50,000 as the change, net change, that is 1,50,000 divided by 26 lakhs and 10,000 will get 5.75. Then profit before taxes, we have 6 lakhs in 2013, 4,50,000 in 2012, we will get 1,50,000 as your net increase. So 1,50,000 divided by 4,50,000 will get 33%. Again income tax, we have 2,25,000 and we have 3 lakhs, so 75,000 is your net increase. 75,000 divided by 2,25,000, I will get 33.33, that is 1/3. Then profit after tax, we have 75,000, again an increase, divided by your 2,25,000 will get 33.33. As this taxation percentage is 50%, these two items are coming in a same figure. Suppose it goes to 40%, then the items will change. We shall pass on to the third problem. From the following statement of profit and loss, prepare a comparative income statement. We have income, revenue from operations 4 lakhs in 2012, then 5 lakhs in 2013. Other incomes 20,000, 30,000. Total of your incomes 4,20,000 and 5,30,000 in 2013. Expenses includes purchases, changes in the inventories, employee benefit expenses and other expenses. Purchases is 1,80,000 in 2012, 3,10,000 in 2013. Changes in the inventories of stock in trade, it is 20,000. Then it is put it in bracket, that is 10,000, 2013. 10,000 women, we have a decrease in the changes. Employee benefit expenses 30,000 and we have 80,000. Again other expenses, it comes to 70,000 and 90,000. We have a total of your expenses as 3 lakhs in 2012 and 4,70,000 in 2013. So net profit is all your incomes minus your expenses. 1,20,000 in 2012 and 2013 we have 60,000. Here is an additional information given. Other expenses include provision for tax 60,000 in 2012 and 70,000 in 2013. This is for your 2012 and this is for 2013. See here, this other expenses includes the provision for tax. This provision for tax is a balance sheet item that will appear only in balance sheet. This should not be included in the income statement. See, this other expenses for 2012 is 70,000. Out of the 70,000, 60,000 is your provision for tax. So deduct your 60,000 from the 70,000, 10,000 is said to be the expenses for 2012. The same way for 2013, we have 90,000 minus your provision for tax as 70,000, we will get 20,000 for 2013. So we have to compare only 10 and 20 here, and this provision will go to the balance sheet item, and that will be calculated only in the comparative balance sheet. We shall see the solution here. Revenue from operations, we have 4 lakhs and 5 lakhs. So net increase of 1 lakh. So this is 25%. That is 1 lakh divided by 4 lakhs. Other income, we have a net increase of 10,000. So 10,000 divided by 20,000 into 100, we will get 50% increase. The total of your income is 1 lakh 10,000 is a net increase, and this 1 lakh 10,000 divided by your previous total, that is your 4 lakh 20,000, will get 26.19%. That implies that the revenue has increased by 26.19 over the previous year. Purchases of stock in trade, we have 1 lakh 30,000 as your increase. So increase divided by 1 lakh 80,000 will get 72.22. Changes in the inventories of trade, we have 20,000 in the previous year and 10,000 as a decrease in March 2013. So 20,000 minus of minus 10,000. So it comes to 30,000. That is 20,000 plus 10,000, it comes to 30,000. So we have 150 as percentage. The next is employee benefit expenses. We have 30,000 and we have 80,000. Net increase of 50,000. It is 166.67. Other expenses less tax provision. As we have already told, tax provision must be deducted and 10,000 and 20,000 should be taken into account. We have a net increase of 10,000, so it will be 100% increase. Total expenses 2 lakh 40,000 and it is 4 lakhs. 1 lakh 60,000 is a net increase, so we will get 66.67. Now profit before taxes, total of all your revenue from operations minus your total expenses, it comes to 1 lakh 80,000 for 2012 and 1 lakh 30,000 for 2013. So we have a net decrease of 50,000. So decrease is 27.70. That is, the profit has decreased by 27.70. Income tax is 60,000 and 70,000. We have an increase of 10,000. So it is 16.67. See here, the profit shows a positive figure in 2013. That is why the tax is paid. It is a profit earned during 2013. But when we compare it with the previous year, the profit is decreasing. So the third column, absolute change, is said to be the percentage of decrease. Percentage of decrease woman, the profit has decreased, but it doesn't mean that the organization is incurring a loss. So it is a decrease in your profit. Again, profit after tax is 1 lakh 20,000 and we have 60,000. We have a 60,000 has decreased, so 50% the profit after tax has decreased. See, we have a total of your revenue as 26.19 and we have a total expenses as 66.67. That is why the profit before tax shows you a negative figure, because it has a greater increase. 2/3 it has been increased. The expenses have been increased by 2/3, but the revenue has increased by 1/4. So this has resulted that there is a decrease in your profit by 1/4. Again, profit after tax is decreased by 50%. That is, half of the profit has been decreased. This is the way in which we have to interpret the comparative income statement. We shall see how this is presented in a comparative balance sheet. See to it, shareholders funds, we don't have any change, so we don't have any percentage of increase or decrease. Again, reserves and surplus, we have a change of 1 lakh. So 1 lakh divided by 5 lakhs, we have 20% as change. Then shareholders funds, we have 30 lakhs and 31 lakhs. We have a 1 lakh of increase, so it comes to 3.33. Next comes the long-term borrowings. We have 15 lakhs and 15 lakhs. We don't have any change here. Then short-term borrowings, bank overdraft, we have 2 lakh 25,000, 2 lakh 40. We have an increase of 15,000, so it is 6.67. And we have trade payables as 2 lakhs and 2 lakh 25,000. We have 25,000 as increase. We have 12.50. Then we have current liabilities 50,000 and 55,000. So the net increase of 5,000. So it comes to 10%. Short-term provisions 25,000 we have. Here we have 30,000, an increase of 5,000. So we have 20% increase. Then total we have 5 lakhs, 51 lakhs, 50 lakhs, 5150, 1 lakh 50 is your increase. So 3% is your increase. Now non-current assets, fixed assets we have 30 lakhs, 36 lakhs, we have a 6 lakhs, 6 lakhs divided by 30 lakhs, we have 20% as increase. Non-current investments we have don't have any change as 5 lakhs remains the same. Then current assets we have inventory 7 lakh 50, 5 lakh 50, we have a decrease of 22 lakhs. So see here the decrease has been shown in a bracket. So whenever any figures are mentioned in the bracket, that shows a decrease. Again the percentage should also be written in a bracket, that is 26.67. Then trade receivables 5 lakhs and 3 lakhs, again it is 2 lakhs a decrease, again 40% is a decrease. Cash and cash equivalents we have 1 lakh 50,000, 1 lakh 75,000, we have a 25,000 of increase, this is 16.67. Other current items we have 1 lakh 25,000, again we have a decrease, so 75% as a decrease. See again total comes to 3%. So this total 3% and your liabilities total 3% must remain the same. On to the problem number 3. Equity and liabilities again the same way we have share capital of 36,000, reserves and surplus 12,000, 15,000. Non-current liabilities we have long-term borrowings of 17,000, 25,500. Current liabilities we have trade payables 15,000 and 12,000. So the balance sheet total is 74,000 and 88,500. Assets we have non-current assets, namely fixed assets, tangible it is 50, 65, intangible 10, 10. So totally we have 60,000 and 75,000. Trade receivables 12,000, 12,500. Cash and cash equivalents 2,000, 1,000. We have 14,000 and 13,500. Again the total of the balance sheet comes to 74,000 and 88,500. Though the items are given in total, whenever we are going to prepare a comparative balance sheet, we have to show the items individually. Now see to it equity and liabilities. We have a share capital. Share capital is 30,000 and 36,000. We have a 6,000 as change, so this is 20%. As usual, 6,000 divided by 30,000. Again reserves and surplus we have a 3,000 increase, 3,000 divided by 12,000 we have 25%. Then shareholders funds we have 9,000 as increase, so it comes to 21.42. Then non-current liabilities we have long-term borrowings an increase of 8,500, so it is 50% increase. Current liabilities we have trade payables 3,000 as decrease, so 20% as decrease. Total of your balance sheet we have an increase of 14,500, so we have 19.60% as increase. See, whenever we are going to prepare a comparative balance sheet like this, it is easy to compare whether the items have been increased or decreased. So from this we can easily ascertain what will be the solvency position of a firm. Either it may be a short-term solvency or a long-term solvency. Then assets we have, fixed assets we have an increase of 15,000, here we have a 30% increase. Current assets we have trade receivables as 500 as increase, 4.17 is the increase. It is cash and cash equivalents we have 1,000 as decrease, so 50% as decrease. Again the total must be 19.60 as your increase, because 14,500 is said to be the net increase over the last year. So whenever we prepare a balance sheet of your organization, it is better to prepare a comparative balance sheet so that we can easily ascertain whether every item has increased or decreased. In this session, we shall see about common size income statement. We shall pass on to the problem number 1. From the following statement of profit and loss, prepare a common size income statement. We have 31st March 2012 and 31st March 2013. We have the income, namely revenue from operations, that is the revenue from sales, 10 lakhs for 2012, 12 lakh and 50,000 for 2013. We shall see about the expenses, purchases of stock in trade, that is 7 lakh 20,000 in 2012, 8,70,000 in 2013. Changes in the inventories of stock in trade, 30,000 for 2012 and 20,000 reduction in 2013. Depreciation and amortization, 20,000 in 2012, 30,000 in 2013. Other expenses, we have 30,000 in 2012 and 50,000 in 2013. Total, we have 8 lakhs in 2012 and 9,30,000 in 2013. So this is the total expense. We'll have the net profit, that is your total income minus your total expenses. We'll get 2 lakh rupees in 2012 and 3,20,000 in 2013. Let us now see how this common size income statement has been prepared. While preparing the common size income statement, we'll take the revenue from operations as 100 and other items are calculated in proportion to the sales. So in percentage to the sales. So this is a vertical analysis wherein we are going to convert all the items in the same year to the sales. Let us now see how this solution has been arrived. First we have the absolute amounts. Absolute amounts women, whatever that is given on the balance sheet, we take it as absolute amounts. We have 2012 and 13 as such given on the problem, and we have percentage of revenue from operations, that is your net sales, 100 rupees, 100% in 2012 and 100% in 2013. That is 10 lakh in 2012 has been converted into 100. And again 12,50,000 in 2013 has been converted as 100 in 2013. Now other items, namely the expenses, will be converted in relation to the sales, namely the revenue from operations. See, 7,20,000 is converted to the proportion of the sales in 2012. I will tell you how the calculation has been made. If 100 is 10 lakh is taken as 100, what is 7,20,000? That is 100 divided by 10 lakhs. When we take this 10 lakhs into 7,20,000, so we will get 72%. So if this 10 lakhs is taken as 100, what is 7,20,000? The same way, 8,70,000 is calculated as follows. Say 12,50,000 is taken as 100, what is 8,70,000? So we will get 69.60. This implies that when we have 100% sales, we have 72% as stock and trade purchases. Same way in 2013, if 100% is the sales, we have 69.6 as your purchases of stock and trade. See to it, the proportion has decreased. We can also have a comparison over the past year also. Out of sales, we have 72%. Now it is only 69.60%. Next, changes in the inventories of stock and trade. The 30,000 is again converted in relation to your revenue from operations. If 100 is your 10 lakhs, what is 30,000? That is 3%. Again, when you come to 2013, it is reduction of 1.60%. Then employee benefit expenses, it is 20,000. Again, it is converted in relation to sales, we will get 2%. The same way for 2013, it is 2.40%. Other expenses, we have 30,000 for 2012, 50,000 for 2013. So this 10 lakhs is taken as 100, and what is 30,000? It is again 3% and again 4% for 2013 when we take 12,50,000 as 100. We have the total expenses again 8 lakhs. See, this 8 lakhs should be compared with your 10 lakhs now. So we should not take into your individual components. When we take total expenses, we have to take the total as such. So if 10 lakhs is 100, what is 8 lakhs? So 80%. That means that out of 100%, 80% is your total expenses. So the remaining 20% is your profit. Same way for 2013, we have 74.40% as your total expenses. So we will get 25.60 as your percentage of profit before tax. So this is the way in which we are going to calculate your percentages based on your common size. We shall pass on to the second one. Prepare a common size income statement from the following statement of profit and loss. We have income, same way we have revenue from operations 10 lakhs for your 2012 and 13 respectively. Other income we have 10,000 and 11,000. Then your total is 10 lakh 10,000, 10 lakh 11,000. So this is your total income. When we have your expenses, again purchases of stock in trade 6 lakhs 50,000, this is 7 lakh rupees. Changes in the inventories of stock in trade 50,000 in 2012, 48,000 in 2013. Employee benefit expenses, we have 80,000 in 2012, 98,000 in 2013. Other expenses, we have 1,17,500 and 90,000 in 2013. Then when we deduct this, when we add this, we'll get your total expenses as 8,97,500. We have 9,36,000 in 2013. Profit, as usual, we arrive the difference between your income and expenses. As your income exceeds your expenses, we'll arrive at a profit of 1,12,500 in 2012 and 75,000 in 2013. We have an additional information wherein other expenses include the provision for tax 1,12,500 and 75,000. As this is an income statement, this provision for tax should not be taken into account and we will deduct it from other expenses. So the remaining amount will be considered as your expenses for the calculation of your common size statement. See, revenue from operations, we have 100%, 100%. That is, we take your net sales as your base. Again, other income 10,000. Again, this is converted into percentage. That is 10 lakhs is 10%, 100%. What is your 10,000? So 1 0 is missing here. 10 lakhs is taken as 100 and what is your 10,000? Again, we have your 11,000. Again, this is 10 lakh is converted into 100. What is your 11%? Sorry, 1.10%. Total revenue, this is 10 lakh 10,000. So this is compared with your 10 lakhs, we have 101%. Again, revenue from operations is taken as 100 in 2013. Again, that is compared with your total revenue. So we'll get 101.10%. Expenses, we have 6 lakhs 50,000 compared with your previous sales, we have 65%. The same way 7 lakhs is compared, we'll get your 70%. Again, we mean that 65% of your total sales is your purchases. That is a proportion of your purchases to your sales. Again, 70% is the proportion to the sales in 2013. Changes in the inventories of stock in trade. 50,000 we have, 48,000. Again, this 50,000 is compared with your 2012 sales, it is 5%. And again, 48,000 is compared, we'll get 4.8%. Employee benefit expenses, we have 80,000 and 98,000. So we have 8% and 9.80%. That means that we have 1.80% of increase over the past year. Then other expenses, we have 5,000 and 15,000. As we already told, this other expenses includes the provision for tax. So this provision for tax is said to be a non-current liability that should not be included in the expenses. So we are deducting it and showing only the remaining as other expenses. So we have 1% increase in the other expenses over your previous year. Total expenses, we have 7,85,000, 8,61,000. So we have 78.50 and 86.10. Now profit before tax, that means all your revenues minus your expenses will get 2,25,000. This is compared with your sales, will get 22.50, and for the next year it is 1,50,000, so you'll get 15%. See to it, here profit before tax has decreased from 22.50 to 15%. So we have a decrease of 7.50, wherein this is said to be a serious matter to be looked into. Then tax, we have 1,12,500 and 75,000, which is said to be the 50% tax. So we'll have 11.25, we'll have 7.50. Again, profit after tax will be the tax after remaining your taxation. We'll have 112,500 and we have 75,000. So that comes to 11.25 and 7.50. See to it, we have 11.25 and 7.50. So we have nearly 3.75% of decrease in your profit after tax. So this is the way we are going to compare it. So we are going to take the sales as 100 and you are going to convert the other items in relation with the sales, and we are going to compare it with the next year also. So when you are going to compare it with the next year, that is we can find out whether an increase or decrease or a constant place of your expenses or your incomes. Now when we come to this common size income statement, what does this name means? We are going to make all the items in a common flat form. So that is called as a common size. So we are going to make all the expenses in relation to your sales as far as the income statement is concerned. So this is the way to interpret your common size income statement. Let us see the next problem. Revenue and expenses data for the current calendar year for Star Paper Mills Limited and for the paper industry as follows. The Star Paper Mills Limited data is expressed in rupees and the paper industry averages are expressed in percentages. So now we are going to study the information regarding a paper mill and we are going to have an industry average also. Now we are going to compare the industry average with the firm's average. See to it, the income we have revenue from operations 70 lakhs, other income 35,000, we have total income as 70 lakhs and 35,000. So this revenue from operations is given in note number 1. Then expenses we have cost of materials consumed is note number 2, 48 lakhs. Changes in the inventories of finished goods and work in progress we have 2 lakh 40,000. Employee benefit expenses 5 lakh 74,000. Other expenses 9 lakhs 24,000. We have total of 65 lakhs and 38,000 as expenses. So the profit as usual 70 lakhs 35,000 minus 65 lakhs and 38,000 will get 4 lakh 97,000 as profit. Let us now see the notes to the accounts. Revenue from operations. What is this revenue from operations? That is your net sales. Gross sales is 70 lakhs and 70,000 and we have a returns of 70,000. That is your sales returns of 70,000. So we have a net sales of 70 lakhs. This is said to be the revenue from operations. So we can take it as net sales. What does this net sales mean? That is sales minus your returns. Then cost of materials consumed. What is this cost of materials consumed? Opening stock of raw materials plus the purchases of raw material minus your closing stock of raw material. Now let us see what are all the items to be added and what are all the items to be deducted here. Now opening stock is 1,50,000. We have a purchase of 49 lakhs and 50,000. So total inventory in hand as such is 51 lakhs. Now we have a closing inventory of 3 lakhs. So we have the cost of materials consumed as 48 lakhs. Then changes in the inventories of finished goods and work in progress. Work in progress finished opening inventory is 4,50,000 less your closing inventory, that is your 50,000. Changes women, the difference between your opening and your closing balances. And again finished goods, we have opening inventory of 4 lakhs, closing inventory of 2 lakh 10. So we have a change of 1 lakh 90,000. Now employees benefit expenses. What are all the employees benefit expenses? We have salaries and wages, that is 5 lakhs and 74,000. Other expenses includes general expenses, miscellaneous expenses, namely the sundry expenses, provision for tax and other expenses. We have 4 lakh 34,000 as general expenses, miscellaneous expenses as 84,000, provision for tax as 406 and other expenses as 9 lakh 24,000. So these are the details regarding the items that are shown in the income statement. See, this is the industry average that is given. Revenue and expenses data for the paper industry is as follows. Cost of materials consumed is 67%. Changes in the inventory is 3%. Employee benefit expense is 9.2%. Other income is 0.6%. Other expenses 9.40%. Income tax is 5.5%. Now we are going to prepare a common size income statement comparing the results of the operations of Star Paper Mills Limited with the industry average. So when we say an industry, it is a combination of, or it's a, the full form of your firms. Firms is said to be the Star Paper Mills here and industry is said to be a group of firms. As far as the data permits, comment on the significant relationship revealed by the comparison. First, we have to prepare a common size income statement for Star Paper Mills and then we are going to compare it with the industry average. Common size income statement of Star Paper Mills Limited for the current calendar year. So this is the absolute amount. We have 70 lakhs as your gross revenue, 35,000 is your other income. Total income is said to be 70 lakhs and 35,000. Expenses, cost of materials consumed is 48 lakhs. Changes in inventories is 2,40,000. Employee benefit expenses 5,74,000. Other expenses 5,18,000. Total expenses we have 61 lakhs and 32,000. Then profit before tax, that is all your incomes minus your expenses. That is 70 lakhs 35,000 minus 61 32,000. That will give you 9 lakh and 3,000. Now provision for taxes deducted, that is 406. We will get profit after taxes 4 lakh 97,000. Now we are going to have all the sales, that is the sales for the year is taken as 100. As usual, we are converting all the items in relation with the sales. That is 0.50 is your other income. So total income is 100.50. Cost of materials consumed comes to 68.23%, and goods and work in progress is said to be 3.1%. Employee benefit expenses is 8.15, other expenses is 7.38. And we have total expenses as 87.23, and we have profit before taxes 12.83%, and it is 5.80% as tax and 7.17% as profit after tax. So this is the information regarding the Star Paper Mills. We have an industry average given on the problem. Now we are going to compare it with the industry average. 100% is a revenue and 0.6 is said to be the other income, but this is said to be 0.50, so they are less than the industry average. Now 67% is said to be the cost of materials consumed, they have consumed 68.23, so this is higher than your average. Then again slightly we have 0.1 as increase in your changes in the inventories. And when the employee benefit expenses are concerned, it is 8.15, this is 9.20, and other expenses we have 7.38 and 9.40. So when we compare it, this comes to 18.6% and this comes to 15.6%. So when we have this, the expenses that is incurred by the Star Paper Mills is said to be lesser than the industry average. And we have the total expenses of 88.60, so we have in the individual averages 87.23. So this is lesser than the industry average. Now profit after tax is 12% here, and we have 12.83, and we have an industry average of 5.5% as tax, 6.5% as industry average, but the company is able to earn 7.11%, which is higher than the industry average. This is because of the reduction in the expenses. See, the comments on the above table reveals that profit after tax of the company is more than the industry percentages. The reason for this is better control on expenses, resulting in the lowering of expenses. The expenses other than the cost of merchandise sold, that is your employee benefit expenses and other expenses, are said to be lesser than the industry average. So this industry average, this 9.20 and 9.40 comes to 18.6. This comes to 18.6%. And when we come to this firm, these two comes to 15.6. So this is 18.6, this is said to be 15.6. So we have a 3% reduction in your firm's expenses. So this 3% has made an increase of profit, increase of profit by 0.61%. So this is an increase we expected on the profit. So this is the increase in profit because of the reduction in expenses. So this is how we are going to compare the firm's average with your industry's average. We shall now see common size balance sheet, how the common size balance sheet is prepared. When we come to the common size balance sheet, the total of the balance sheet will be taken as 100, and all the items will be related to the total of the balance sheet. So say for example, the total of the balance sheet on the liability side is taken as 100, and all the equity, internal liabilities and external liabilities will be converted to the total. Again, when we come to the asset side, we have the total of the balance sheet as 100, on all the fixed assets and current assets are taken as the proportion to the total of the balance sheet. I will tell you how this calculations will be made. See, following is a balance sheet of XYZ Limited as of 31st March 2012 and 13. Prepare common size balance sheet. Equity and liabilities. We have shareholders funds, namely the share capital and the reserves and surplus. As we already said, reserve is said to be an appropriation of profit, surplus is said to be the profit arrived, remaining in the current financial year. We have share capital of 5 lakhs in 2012 and 3 lakhs of reserves and surplus. In 2013, it is 10 lakhs and 2 lakhs respectively. Long-term borrowings, it is 5 lakhs in 2012, 8 lakhs in 2013. Current liabilities includes the trade payables here, 2 lakhs in 2012 and 4 lakhs in 2013. So the total of the balance sheet comes to 15 lakhs and 24 lakhs respectively for 2012 and 13. All the assets are depicted here. When we come to the non-current assets, we have the tangible fixed assets, namely 10 lakhs in 2012 and 15 lakhs in 2013. Current assets is said to be the cash and cash equivalents. We have 5 lakhs in 2012 and 9 lakhs in 2013. Again, we have the total of the balance sheet as 15 lakhs and 24 lakhs respectively. So this 15 lakhs is now taken to be 100 and 24 lakhs is taken to be 100 and convert all the items to the total of the balance sheet. Let me now explain about the solution for the problem we have seen now. This is balance sheet of XYZ Limited. Now as of 31st March 2012 and 13, we have the absolute amounts. Whatever we mean it as absolute amounts, it is shown in the balance sheet itself. Say, as we already told, share capital, reserves and surplus, then current liabilities, that is long-term borrowings, current liabilities, and we have fixed assets and your cash and cash equivalents. Same way for 2013 also, we have 10 lakhs, 2 lakhs, so we have long-term borrowings of 8 lakhs, 4 lakhs is payables and 24 lakhs is your balance sheet. Then non-current assets, we have 15 lakhs, 9 lakhs as your cash and cash equivalents, we have 24 lakhs. Now, we are going to calculate the percentage now. As I have already told, the total of the balance sheet will be taken as 100 now. Now, 15 lakhs is taken as 100, 24 lakhs is taken as 100. Now, see to it, if 15 lakhs is 100, what is 5 lakhs? That is 33.33. So, we will take it as 100 divided by 15 lakhs into 10 lakhs. So that will give you, this is 5 lakhs. This is 5 lakhs. 100 divided by 15 lakhs into 5 lakhs will get 33.33. The same way, 15 lakhs means converted into 100 and what is your 3 lakhs will have 20%. Same way for long-term borrowings, we will have 33.33% and trade payables as 13.33%. So when you add all these items, we will get 100 as your total. Same way, if 100 is your 15 lakhs, what is 10 lakhs? 66.67. 5 lakhs is 33.33. See to it, we have a total of 100. Same way for 2013. We got total of the balance sheet as 24 lakhs. If this is said to be 24 lakhs, what is your 10 lakhs? This is your calculation, that is 41.67. Again, reserves and surplus comes to 8.33 and then long-term borrowings comes to 33.33. Trade payables comes to 16.67. Again, as usual, when we add all these items, it must be 100 now. Again, your deployment, that is your assets. Fixed assets must be 62.50 and cash equivalents must be 37.50. We have a total of 100. This is how we are going to prepare the common size balance sheet. Now, we can easily compare it over the years also. See to it, 33.33 is said to be the share capital. Now, it is 41.67. That means the share capital has been increased. The same way we have 20% and we have 8.33%. That means the appropriation of reserve has decreased. When we come to the long-term borrowings, it is 33.34% and 33.33. That is 1/3 of your total capital is said to be long-term borrowings. So the proportion is maintained here. Again, current liabilities, we have a decrease in the proportion. The same way for their fixed assets, we have a decrease in the proportion. That is, though the fixed assets have increased, but the proportion to the total balance sheet has decreased. The same way, cash and cash equivalents, we have an increase in your proportion. This is why how the balance sheet can be compared over the years. We shall see the problem number 2. From the following balance sheet of Sun Limited as of 31st March 2012 and 13, prepare a common size balance sheet. Again, shareholders funds, we have 60,000, reserves and surplus 8 lakhs, then current liability, long-term liabilities we have 20 lakhs, then current liabilities we have 12 lakhs. So total is said to be 1 crore. Then asset side we have 60 lakhs as intangible assets, intangible as 12 lakhs, current assets is inventories is 20 lakhs, cash and cash equivalents as 8 lakhs. Again we have a total of 1 crore. Then 2013, share capital is 80 lakhs, reserves and surplus is 12 lakhs, then long-term borrowings is 24 lakhs and short-term borrowings is 4 lakhs. We have 1 crore and 20 lakhs. The same way for your assets, 80 lakhs is your tangible assets, intangible is 4 lakhs, then current assets we have 24 lakhs, then inventories is 12 lakhs, we have 1 crore and 20 lakhs. Now let us see how this balance sheet has been prepared. So first two columns we have the absolute amounts, that is shareholders funds. We have 60 lakhs, 8 lakhs, 20 lakhs, 12 lakhs, we have a total of 1 crore. Again tangible assets we have 60, intangible we have 12, current assets we have, this should be in the higher ups. So this is cash and cash equivalents 8 lakhs. Now we have all these things must have one line above. So this is 60%, 12%, 20% and 8%. Again share capital we have 60%, 8%, 20% and 12%. So when you add all these items we must have 100%, that is total of the balance sheet is taken as 100. The same way for 2013 we have 66.67 for shareholders funds, 10 as your reserves and surplus, again 20% for your long-term borrowings and 3.3% as your short-term borrowings. The same way for your tangible assets we have 66.67, 3.33, 20% and 10%. So again this should be equivalent to 100. Now this way comparison is also easy. See to it, when we have 60% here and we have 66.67%, that is we have an increase in the tangible assets. All these items must have one space above. Let us pass on to the problem number 3. The balance sheet of Star Paints Limited as on 31st March 2012 and 13 are given below. Prepare a common size balance sheet of Star Paints Limited for 2013 and 12 and 13. Again shareholders funds we got 2,74,000, reserves and surplus 1,52,000, then long term borrowings 1 lakh, then unsecured loans we have 5,96,000, short term borrowings, that is your bank overdraft is 1,25,000, trade payables 1 lakh, other current liabilities 50,000, short term provisions is 23,000, total of the balance sheet is 14 lakhs and 20,000. Same way we have assets, tangible assets, net tangible assets, that is after deducting your depreciation 5,68,000, non-current investment 6,000, current assets we have inventories of 4,26,000, trade receivables 3,30,000, then we have cash and cash equivalents 90,000. Again we have a total of 14 lakhs and 20,000. The same way for 2013, we have shareholders funds 2,74,000, reserves and surplus 70,000, then non-current liabilities, that is long-term loans is 2,32,000, all your secured loans, namely it may be the debentures. Unsecured is 2,06,000, then short-term borrowings we have secured bank overdraft is 50,000, trade payables is 20,000, other current liabilities 3,000, short-term provisions as 5,000, total of the balance sheet is 8,60,000. Again non-current assets consists of fixed assets 4,30,000, then we have non-current investments as 4,000, current assets includes the inventories of 2,16,000, then trade receivables 1,40,000, then cash and cash equivalents among the bills receivable also 70,000, so total we have 8,60,000. We have the solution for this problem. As usual, we have an absolute amount and we have the percentage to the balance sheet total. So this total of the balance sheet 14,20,000 is taken as 100 and 8,60,000 is taken as 100. The same way on the asset side, 14,20,000 is taken as 100, then 8,60,000 is taken as 100. So all these items are converted to this balance. The same way in this here, we have the conversion to this balance. For the asset side also, we have this conversion to the balance of 4,20,000. The same way for 2013, we are converting this 8,60,000 as 100. Now, see to it, 2,74,000 is converted and it is 19.3. Then reserves and surplus 10.7. Then non-current we have secured loans 7. Then unsecured 42% and provisions is 21%. So out of this 100, we can easily say that 19.3% is your share capital and 10.7 is your reserves and surplus, 7% is your long-term borrowings and 42% is said to be unsecured loans of long-term borrowings and 21% is short-term borrowings and provisions. The same way for 2013, we can say 31.9% as share capital, 8.1% as reserves and surplus, 27% as long-term secured loans, then 24% as unsecured loans and 9% is your short-term borrowings. See to it, the proportion 19.3% is increased to 31.9, right? So this shows that the proportion to your own balance sheet total has increased. That is, say the balance sheet total 4,20,000 is decreased to 8,60,000. So this changes in your percentages are right. Again 10.7 is decreased to 8.7. Why this changes is made is only because of the changes in your total balance sheet. And again you have a long-term secured loans as 27%. We have an increase. And again we have a decrease in your unsecured loans and we have a decrease in your short-term borrowings. So the secured long-term borrowings are increased. Now when we come to the current assets again, it is 40. Current assets we have 30% of your inventories, here 25.1. Then trade receivables is 23.2, it is 16.3, 6.4 in 2012, 8.1 and 2013. So we have an increase of your cash and cash equivalents, but we have a decrease of your inventories and trade receivables. Again when we have fixed assets, it is 40% and 50% and 0.4 for your non-current investments, 0.5 for your non-current investments. And again this changes in your percentages in 2013 is mainly because we have a difference in the balance sheet total. That is from 14,20,000, it has decreased to 8,60,000. So this changes is compared with your last year and we have to predict it for the future year. So this is how the balance sheet is prepared based on your common size financial statement analysis. Thank you. And this is the final version of your comparative income statement, comparative balance sheet, common size balance sheet and your common size income statement and a common size balance sheet. Thank you. Now we shall see the trend percentages, how the trend percentages are calculated. Whenever we have prepared the trend percentages over the years, we will take a base year first and then we will compare the forthcoming years based on a base year. Normally when we do the problems, we will take the first year as a base. But in an organization, it may be a corporate, any corporate organization must calculate the base year as a year which is neither a boom year nor a depression year. So it must be an average year and this year will be taken as a base and the other years will be calculated. Say whenever we prepare a trend percentages, it is easy to calculate whether every item has increased and whether we have an increasing trend or a decreasing trend. In case of comparative balance sheet and a common size balance sheet, it may be a comparative statement analysis or a common size statement analysis. We are going to compare it with a single year. We are going to compare with a previous year alone. Say for example in 2013 and 14 or 2012 and 13. So we will have a horizontal analysis and we are going to have horizontal analysis or vertical analysis. We are going to compare it only with a single year. So when we come to this trend percentages, we are going to calculate over the years. So this is easy to extrapolate to the future years also. So forecasting of your figures based on your previous percentages is possible in case of trend percentages. This trend percentages is said to be a useful technique in the hands of the management to predict the change in your sales or change in your expenses or change in your other revenues or your assets, whatever items you are going to calculate. So, it is easy to predict the change in the items over the years also. So, this is once again a postmortem analysis of what has happened in your previous years, and it is said to be an extrapolation of your figures to your future years. So, interpolation is also possible and extrapolation is also possible. And when you are going to have a cross-sectional analysis of your financial statements, this trend analysis is said to be a useful technique in the hands of a management. Let us now see how this trend percentages are calculated. Every base year should be, every item in a base year should be taken as 100. And the items of other years will be correspondingly changed in terms of your base year. See to it, when you see one problem, you will be able to understand. The following are the extracts from the income statements of Bright Limited for 6 years ending 2009. You are required to calculate trend percentages. Taking 2004 as a base year, give two major conclusions you can draw. See here, we have 2004, 5, 6, 7, 8, 9. So, we have 6 years here, all the figures are in thousands. We have sales, cost of goods sold, office expenses, selling expenses, net profit or loss. So, we have 300, 340, 420, 480, 520 and 600 as sales. Cost of goods sold we have 180, 204, 256, 287, 300 and 330. Office expenses we have 40, 42, 45, 50, 55 and 60. Selling expenses we have 20, 25, 30, 40, 50, 60. Net profit or loss we have 60, 69, 89, 103, 115 and 150. See, in this case we can easily calculate, say for example I will take office expenses now. We have 40,000 in year 2004, we have 42,000, we have an increase of 2,000 here. Then from 42 to 45, we have an increase of 3,000 here. Again we have 45 to 50, we have an increase of 5,000. Then 50 to 55, 5,000, 55 to 60, 5,000. I will now say 40 to 42, we have an increasing trend. Again from 42 to 45, again we have an increase in the increasing trend. See, here we have 2,000 as increase, here we have 3,000 as increase. Again when we have 5,000 as increase, it is a further increase in the increasing trend. So, it increases by 2,000, again by 3,000, again by 5,000. So, we can predict the expenses in office is increasing at an increasing trend. Again, whenever the expenses are increasing in an increasing trend, the management should justify the productivity of the amount spent. So, that is the responsibility is fixed on the management to say whether the expenses are when the expenses are increasing at an increasing trend. Parallelly, you must have an increase in the productivity also. Otherwise, the increase in the increasing trend of your expenses is not justified. See to it for the other 2 years, we have a constant increase. We have 50 to 55 and 55 to 60. The expenses have increased, but the increase is at a constant rate. So, when we have a constant increase, again we have to justify whether the constant increase has been properly managed or not. Say for expenses, selling expenses, we have 20 to 25, 5,000 increase, 25 to 30 again 5, 30 to 40, it increases by 10,000, again 40 to 50, 10, 50 to 60, 10. So, it increases in an increasing trend. At times, we will have a decreasing trend also. Certain expenses will have a decreasing trend. So, this decreasing trend in expenses shows a favorable position. If we have an increasing in the increasing trend, it is an unfavorable position or an adverse position unless the increase is justified by the management personnel. We will see how the expenses are calculated here. Statement showing the trend percentages for the period from 2000 to 2004 to 2009. See this first column, 6 columns, namely 2004, 5, 6, 7, 8, 9. This is said to be the rupees in thousands. The second half is said to be the trend percentages having the base year as 2004. Now, whatever items we have shown it in the previous problem, we are going to realign it. We are going to rearrange it in a form of a statement. Say sales less cost of goods sold will get gross profit. Gross profit minus all your expenses will get a net profit. In the problem, it will be simply given with all items. Now, we are going to classify it and we are going to show what is the net revenue that is got by the organization. See, all your 2004 figures are converted as 100. All your figures are converted as 100. Now, 2005, 113, I will tell you how this 113 has been arrived. See, 300 is taken as 100. So, 100 divided by 300 into, so this 300 is taken as 100 into, what is here? 340. So, 340 is calculated here. So, you will get 113. So, this 113 is calculated like this. Got it? So, 100 by 300 into 340. I will tell you by next 113. See, this 113 is calculated like this. Say here 100 by 180. 100 by 180 into 100 by 180 into 204. So, this is said to be 113. So, do not have a wrong notion that the same 113 is drawn here. No, every year the 100 is related with your previous year. Say, I will tell you this 140 is how this is calculated. Now, 100 by 300, 100 by 300 into, what is the related figure here 2016? 420. So, into 420. This is the way this 140 has been arrived. Same way 160. 100 by 300 into 480. Again 100 by 300 into 520. So, horizontally when we take this 100 by 300 is taken. But when we come to this next year, next step, that is cost of goods sold, we have to take this 100 and 180 here. Again this 100 and 120 here. Again 100 and 140 here. 120 here. Again 160 here. Again 160. So, every time you have to calculate this base year as 100 multiplied by your respective years. When you want to calculate for 1 year, you have to take this figure 136. So, every time you have to calculate the base year as 100 and convert all your figures into 100, I mean into the ratio of your previous year. See, what are the major conclusions they have got? There is a steady growth in the states, that is your gross profit and net profit of all of which grew by 100% or moreover over the 5-year period after the base year. Say sales, we have 113, 140, 160, 173, 200. We have a steady growth of it. Then we have gross profit 130, 137, 161, 183, 125. So, we have a steady growth. Again when we come to profit, we have 115, 148, 172, 192 and 250. We have a steady growth. Then selling expenses. Selling expenses have been gradually increasing. See to it 125, 150, 200, 250, 300. So, this is increasing. Say whenever the selling expenses is increasing like this, the management should justify the sales have increased only because of the selling expenses. So, the same way we have to justify each and every expenses here. Let us now see the second one. From the following balance sheet extracts, compute trend percentages and comment on the liquidity position of X Limited. Take as 2000 as base year. 2000, 2001, 2, 3, 4, 5. We got stock, data, cash and current liabilities. Whenever the items are given like this, we can add these 3 items and write it as total current assets, and we have the current liabilities. Even this current assets minus current liabilities, you can write it as working capital also. There is no similar, any specimen or any format that is given for your, realigning or rearranging of your items. It is in our way we can interpret it. Say stock, we have 1,50,000, 170, 190, 230, 220 and 2 lakhs. Same way debtors, we have 140, 120, 80, 90, 1 lakh and 1 lakh. Cash, we have 60, 50, 50, 60, 90 and 1 lakh. Again current liabilities, we have 3 lakhs, 3 lakhs 20,000, 3 lakhs, 2 lakhs 80,000, 2 lakh 40 and 2 lakhs. We shall see how this calculation has been made. Statement showing the trend percentages. Again, as usual in the previous problem, we can say all these items are said to be year-end items and all these items are said to be the base year items. We have stock, data and cash, we have the total current assets, less your current liabilities, we can have a working capital. Again, all your 2000 figures are taken as 100. The same way, say this 100 is equated to this 150, this 100 is equated to 140. Again, the same way this is equated here, the same way this is equated here. Again, whenever we want to calculate as 113, it is 100 divided by 150 into 170. This will give you as 113. The same way 2001 figures should be calculated 2 and 3, 4, 5. So, see here 113, 127, 153, 147, 133. So, here we have a decrease in your stock. Again, the same way we have a decrease in the stock in the year of 2002 and again it is an increasing trend in year 2004. Again, it is a constant rate in 2005. The same way, total current assets, we have a decrease in the last year. The same way, we have total current liabilities, we have a decrease in the last year and working capital, we have an increase. So, the same way we have to calculate and we have to find out whether there is an increasing trend or a decreasing trend. So, in the first 3 years, liquidity position was highly unsatisfactory because we have 40, 40 and 20 and last 2 years the working capital position, which is said to be the economic barometer of any organization, is said to be satisfactory here and this is to be improved and by 2005, the liquidity position has become normal and satisfactory. The growth trends says that working capital is reassuring. We will come to the last one. Problem number 3. From the following data, you are required to calculate 10% taking 2001 as base year. We have cash, data, stock in trade, we have other current assets, land, building, plant and total. So, we have your total of your current assets and total of your fixed assets and we can find out your total assets. The same way 2001, 2, 3, sorry this should be 2002. 2001, 2002 and 2003 and 4 has been given. Statement showing the trend percentages. We have the trend year in rupees in thousands here 2001, 2, 3 and 4. Again this is 2001, 2, 3 and 4. Again we have the 2001 as your base. As usual, this is taken as base here as we have already said. And this is calculated as 100 divided by 100 into 120. 100 divided by 100 into 120. So, this is the way in which we are going to calculate the figures for 2001, again 2002, 3 and 4. See here we have a decreasing trend, again we have a increasing trend. The same way we have an increasing trend here in case of datas. See that data has an increasing trend and stock in trade is also an increasing trend and we have other current assets, we have an increasing trend. That is why we have an increasing trend of total current assets. We have land again a constant rate of increase and again we have an increase in the land of building. Plant we have an increase, again fixed assets will have an increase in trend. So, total assets will also have an increasing trend. So, this is the way in which you are going to prepare a trend percentages. So, this trend percentages shows how the assets or any item, assets or liabilities or sales or expenses, how it is showing an trend in the years. So, this trend percentages can be calculated over the years or it can be predicted or it can be forecasted over the future years. Hope you would have understood the trend percentages. Thank you.